Hello, everyone, and welcome to a discussion on onboarding institutions, where we are today and what comes next. My name is Eva Lawrence. I am the head of EMEA for Figment. We are a complete staking solution provider for institutions. Before we kick off, let me introduce you to your stellar panel. Tim, if you want to go first.
Hello, everybody. What a week. I run Europe, Middle East, Africa for Galaxy. Galaxy is a global, regulated, diversified institutional financial services company. We do sales and trading, we do asset management, we do venture, we do investment banking, and we do mining.
Matthew Sigel, head of digital assets research at VanEck. VanEck is a family-owned business, mutual fund and ETF sponsor, about $60 billion in assets under management. About 1% of that is in crypto. So we have a lot of natural resources and gold mining exposure. So we were quite attuned to Bitcoin's potential disruption. We've got 19 different strategies, many in Europe, passive ETNs that you can buy, and then 3 actively managed funds in New York. We're running our own nodes. We have a NFT community project, and we have not blown up. We're still standing here because of that very paranoid approach to counterparties, and we can talk about that more later.
Hi, I'm Mohideen. I'm the CEO of Laser Digital. Laser Digital is a Nomura-backed digital asset company, fully segregated, focusing on 3 major verticals: trading, asset management, and VC. We're based out of Switzerland, London, and Dubai at this stage. Thank you.
Hi, my name is Anatoly. I'm CEO and co-founder of Nickel Digital. We are a London-based FCA-regulated hedge fund running a number of strategies, the flagship being multi-manager, market-neutral platform with 27 managers around the world running different sub-strategies within a larger fund with sub-strategies including Stat ARP, RV, high-frequency market making, different flavors of arbitrage. Initially, the firm was founded 3.5 years ago. My previous background, I was with JP Morgan and Goldman before moving to crypto in 2019.
Thank you, guys. Thank you. So I started prepping for this panel at the weekend. By Monday, I'd crossed out a few bits here and there, tepexed a bit, taken a few pages out. By Tuesday, I'd put a lot of those pages in the bin, and then on Wednesday, just set the bin on fire. So I think that we are going to start off with looking at kind of how we've got to where we are today in terms of institutional onboarding, but we are going to also spend a lot of time discussing the events of the last few days. So in terms of crypto adoption, especially around institutions, we've gone from everything from the wild, wild west, magic internet money, blockchain not Bitcoin, Bitcoin not blockchain, the rise and fall of Bitcoin maxis, gradually, then suddenly, and it seemed like we had maybe reached some stability. And then this week happened. But if we look at 2 weeks ago, there was a report from Fidelity, and the figures showed that 58% of investors surveyed own digital assets, 74% of institutional investors were planning to invest in digital assets, and 81% thought that digital assets should be part of an investment portfolio. I won't ask you if you think those figures are still true today, but I will ask you, what do you think we have been successful in achieving in terms of onboarding institutions to the digital asset space so far? Tim, I'll start with you.
Sure. Well, let's start with when Mike Novogratz stood up at TOKEN2049 in Singapore. He said, "Do you guys not realize what's going on back there? There's like a bull market vibe out there. It's insane." Whose idea was it to put a Rolls Royce and a Lamborghini and a Bentley out front? Like, extra tone deaf, my friends. But institutional adoption looks is an interesting. When the lunar terror situation happened, we were quite surprised, and we focus on institutions. We're not no retail at all. We tend to focus on top-down. You know, we work with some of the biggest banks, sovereign wealth funds, asset managers in the world. And we actually, very counterintuitively, had a big influx of onboarding requests right after Terra Luna. I'll be interested to see what happens next week. Will we see the same reaction? But let's put that to one side. And we were a bit surprised. We kind of thought that that point, like we're all feeling now what might happen is there's going to be a pullback. And we thought that was going to happen back then. And actually there wasn't. We basically, people saw it as a better entry point. And so we're still working through that onboarding backlog, which is worthy of note. It's sort of perhaps counterintuitive. Now, what we get told by those institutional clients is, and by the way, sort of 9 months ago, we got a lot of flack for our lending standards being too conservative and for our documentation being too onerous. Now we get we get plaudits for the same reasons. Now everybody thinks we're great because we have conservative lending standards, and because institutions want certainty, they want documentation, they want legal certainty, and so that's what we give them. And that's, I think, what we've evolved to this year. So aside everything this week, the institutional quality, it's just a non-negotiable for large pools of institutional capital to engage in this space, has increased to the point where we trade with Goldman Sachs, right? We trade derivatives with Goldman Sachs. Like, to get through that onboarding, trust us, is not easy. And I think that's a good barometer, I think, of how we've evolved.
Yeah.
Yeah, the question's about progress. I think the progress that's been made is institutional comfort with self-custody. The amount of man hours in our organization spent on onboarding Fireblocks is not trivial, and that expertise doesn't go away. And it was that comfort that enabled us to essentially pull all our funds off FTX the minute that CoinDesk article hit, and sold our FTT at $18 and just retrenched into self-custody. And I think there's three broad takeaways of what may change post this event. It is a higher emphasis on self-custody. Number two, regulation of centralized exchanges, proof of reserves, like what Kraken is doing, and we heard from the panel before lunch, additional exchanges are doing that as well. And then just more clear disclosure and separation of control between exchanges and their affiliated market makers. And we know that the US lawmakers are looking into that with regards to Binance. That's been in the media, so there will be clearer lines. But the progress is that, those of us who have spent the time now hold our own keys.
Yeah, on our side, there's no questions. Our progress is a result of institutionalization. We are fully backed by a significant financial institution. At the same time, they felt as well to have a segregated entity so that you don't have a contamination or risk. That's a better way to handle it, because it requires certain different sets of governance, although you're extrapolating from the existing set. The way I think more and more institutions are starting to look at the digital asset, like it's not autonomous. It sits within the traditional asset class. If anything, it completes it. With that mindset, actually, more and more traditional governance, whether it's KYC and all that, getting extrapolated. And more institutions getting comfortable. To Tim's point, actually, it's correct. Through the correction as well, what you're seeing is some of the bottlenecks are getting highlighted. If anything, it actually forces to bring more institutional standard, even if you're not an institution. It needs to be institutional-like offering. Bring the agility of course, innovation, what the digital asset brought, but then also you need rigorous governance, also actually fairly deep understanding of the risk, and so forth. So I think with that you're seeing, in the first wave of it, you're seeing more recently institutions are more happy to take exposure to digital asset through investments. You're seeing all the way from sovereign wealth funds to large institutions, and then coming into the space of asset management. Could we have hybrid products with the traditional asset class? I think that's the way institutions are going to approach, because this will not stand on its own. If you're creating a product like risk parity, you will include to your portfolio a digital asset, because it may be diversified. It also gets you exposure to technology and digitization. So That's the way we see
I think whatever numbers were published by Fidelity recently, those can be heavily discounted now, right? And the reason for that being, over the last 48 hours, we got a significant dent in credibility with institutional world. Because those who made these very cautious moves in crypto from the high-level institutional investors, including Ontario with FTX, Quebec pension fund with Celsius, and then subsequently have written this down to zero, they will think twice when to re-enter this space. And unfortunately, it sets bad precedent, so it will take time to cure, and we'll need to clean this mess, right?
Yeah. And
whoever going to be driving, sorry.
And that leads me nicely to my next question. I think we've kind of summarized, we've had some education, we've had some, Mike's back, we've had some education, we've had some interest, we've had governance around custody. There have been some improvements, but as you rightly said, there's been a huge dent in the last 24, 48 hours. And there's going to be cries of, well, there's a lack of transparency, there's a lack of governance, there's a lack of regulation in the crypto space. And what would you say is the main area that those within the industry, in particular in the institutional focused crypto space, need to focus on now to right the ship, as it were?
Yeah, I think risk management and transparency going to be two biggest words in crypto, right? Because you can even see how FTX built its relationship with Copper. Copper, as a custodian, introduced a thing called clear loop. The idea was that you don't have, as a trader, to hold your assets on a given exchange. You can keep them with the custodian whilst exchange accepts, say, your 50 million, which is kept with the custodian, as your margin for the trading on a given exchange. FTX have subscribed to that, but never implemented. And now we know why, because these guys were abusing a client's assets, and they actually needed these assets to be at the exchange. So this lack of transparency will be something which every single trader and institutional investor is going to be extremely sensitive going forward, actually forcing exchanges, as many other players in the market, to kind of adhere to the highest transparency standards. To me, this is a welcome direction. It's just going to be painful getting out of this hole we ended up.
And I think it's going to require some large balance sheets that we haven't seen to become newly active in the space, because while the technology works, self-custody and moving assets back and forth from the exchange, and if you're very nimble, you can avoid the worst case. But if you're really trading, you want to settle at the end of the day with a counterparty that has a big balance sheet and where you're facing an entity that's ideally regulated in the same jurisdiction that you are. And the number of those are just dwindling, right? So my personal view is that it's going to come at the sovereign level, right? We know that the Saudis are mining Bitcoin, right? They're having some problems with the high temperatures and getting those chips to work at 140 degrees, but it's going to have to be a sovereign entity that comes in, buys Bitcoin, mines Bitcoin, sets a floor. They are the biggest institutions that we can imagine, right, as governments. And if there's a wild card in the next 6 months that may turn this around, that would be my bet.
Yeah. Jez, do you have anything
Yes,
to add?
on our side as well, I think there's no question the transparency is key. But what highlights out of all these recent events and kind of over the year is that credit risk is a very key component. It's been taken lightly, whether it's TradFi, CFI, DeFi, credit is credit risk. It doesn't go away. And that requires, of course, transparency. That requires also some regulatory standard in terms of, whether it's a digital shadow banking credit system or somewhere people can trust. Because individuals don't make up institutions. There has to be, deep level of governance, and also you need to have standardization. And regulation needs to come to clarify those standardization. Lack of standardization is also creating this arbitrage within the ecosystem. There's no question you need to have better risk management, kind of rigor needs to come, more institutions need to come in as well, take some ownership of it, exactly to the point. And that's going to come through the ecosystem, give credibility. And solutions like you can't do trades on a bilateral basis. You need to have clearinghouse type of solution, which you saw out of the GFC. So you need solutions around to take out some systemic risk. The problem is here, way too much of systemic risk still exists with few institutions.
You know, I think you said the magic word, Jez. It's the T word, and I think it's coming back because we all forgot it for a while. It's just trust. It's just about trust. And the reason the current financial system is built the way it's built is to afford the right level of trust for all the actors within it, from consumers to institutions to sovereigns. And yeah, when you think about Luna Terra, that was really a crypto native problem, right? That was really, and we all saw what happened there, but it was kind of contained within our little world. This one, SBF, has just gone and, this is Temasek, this is Quebec, this is like some of the biggest, Temasek's one of the biggest sovereign wealth funds in the world. They were hoodwinked. Let's call a spade a spade. They were doing stuff behind the scenes between Alameda and FTX that any rational investor, if they'd seen it, would not have put money into it.
Yeah.
So Blue Trust, as you said earlier, which is actually spot on, so I'm going to steal it.
Go ahead.
He's like that kid who does something in class and everybody has to do extra homework as a result. Like, that's what just happened. So we're all basically going to have to smarten up, grow up, and trust and transparency and risk management and all that stuff. But now it's gotten to a new level. And Chairman Gensler was on the CNBC just a while ago, and he's already poking holes in it. He's like, well, I told you so. So all the stuff that he stood for that's going into the legislation undermines the SEC.
Yeah.
This stuff is going to keep coming up, and it's really annoying, if you can't tell I'm annoyed. As Novo said yesterday, he's angry. But that's the reality that we're faced now.
Yeah, and this is kind of almost what the regulators have been waiting for that I told you so moment, to kind of point the fingers back on the industry and say, I told you so, this is what I was warning against. But in terms of regulation in the space, especially for institutions, what do you think they should be focusing on? Perhaps it's not what they actually are focusing on at the moment, but what do we need from the regulators that is lacking within the industry? I don't know, Matt, if you want to kick off on that one.
I'm a free market person, so I'm not sure that any specific regulation would have cured for this. There's a spectrum on the proof of reserves for a centralized exchange, from a pure self-regulatory, disclosure, and certain institutions will sit down a spectrum, and then there's government regulation by fiat. Our personal view is that with the election that happened, the chances of legislation have gone down, not up. So you'll have just a more hyperactive regulation by enforcement as long as Gensler is around. But it's going to be very spotty, and I hesitate to wish for anything because I don't think the prospects are particularly bright to get anything passed in the U.S. in the next 2 years, right? And it's kind of ironic that it's DeFi, right, that comes out rather clean here. And if you think about what sparked SBF's downfall and when the community turned against him for real, it was after the Eric Voorhees debate on Bankless, which SBF lost in a twitching, very, very strange physical appearance. And then the side that wants less regulation, CZ, was able to bring him down. So I don't think there's a point even in talking about a wish list of regulation.
Jez, any views?
Yeah, I think there's no question these events are going to push faster regulation. The regulators as well thought more recent events, if you look at the correlation risk, like even the last 2 days, it really didn't, the contagion risk is still very limited, despite, of course, it felt like yesterday it's starting to affect traditional markets, still fairly limited. That's actually making it the kind of, the speed at which the regulation is coming through is slow, because if the contagion is much faster, it would have come, which is not a bad thing because you don't end up shutting the system. Instead, actually, you're coming up with something But there's no question the systemic risk few institutions, the regulation will have to come harder to take some of those systemic risks out of it. But regulation first need to also clarify, of course, issues around security is not, and still people cannot take positions around the businesses without having full clarity on it. Plus also global regulators need to come together to solve it. This cannot be just one regional...
Global regulators never come together to solve anything, so...
To an extent, so... But they at least agree on systemic risk. That's what ultimately the GFC draws. So here, it's more systemic. You cannot have few individuals affecting all of us, right? Mm-hmm. So that's a bit, the regulators, they're there to take it out. And again, bring trust to the system. As much as everyone likes decentralization, there has to be a dose of centralization to bring trust to the ecosystem as well, yeah.
So we are trading both on CeFi and DeFi part of crypto ecosystem. Naturally, absolute majority of trades goes through centralized exchanges. I would expect the recent actions actually to push market towards appreciating the security of decentralized structures, right? And push market towards that. However, there is one fundamental kind of obstacle today. In our conversations with institutional investors who are investing in us, very often they're uncomfortable with us kind of going deeper into DeFi. As a matter of fact, their ask is, can you carve out DeFi from your operations? And the reason for that is lack of regulatory clarity, right? And from their perspective, holding indirectly or having exposure to DeFi indirectly opens the whole Pandora box with IML KYC. And I think that's where the regulator should step in, provide clarity to that, and the role of smart contracts. Overall, how they are treated from the legal point of view, what is the recourse, and so on. Once that cleared, we're going to have much greater engagement in DeFi space.
Yeah, I would double down on that. I totally agree with that. This could be a DeFi moment. Let's try and be optimistic. Talk about regulation. There's going to be Monday's going to be interesting. I'll tell you why. Monday's the UK Treasury Select Committee is meeting to discuss crypto. This is one of the most important bodies in the UK legislation. And this is kind of on the back of the Financial Services and Markets Bill, with Rishi Sunak coming in and John Glenn, who between them, they made the announcement back in April that the UK should be a crypto hub. Now they're back on trying to make that work, right? And the interesting, and we're testifying at that alongside, I think it's Binance and a couple of others. But what's interesting is what will their tone be? Because if we've been knocked back by this, and these are not crypto people. We have to recognize, like, these legislators are not crypto people, so we have to help them. We have to educate them. If they take a knock back and they come at Monday in a very sort of aggressive stance based on this week, you know that we're in trouble and we're kind of going to have to add time. But if they're able to see past it and actually think about UK PLC and the potential for London to become a genuine crypto hub, that could pave the way for ETFs in the UK, which is really annoyingly not something we can do that we want to see. And at that point, you start to, you bring like this legislation in theory could bring crypto assets within the regulatory perimeter. Now, I'm also a free market advocate, lesser regulation than more, but bringing it in to an existing framework is a very quick way to get the biggest institutions into this, and those that require trust. So let's be optimistic. Let's hope that is a milestone that we reach on Monday.
Yeah, and they're able to look past the recent events and focus on the industry as a whole. Yeah. So just to kind of wrap up, it's been a crazy couple of days, but in terms of the market as a whole, I think we can all agree that the knock-on effect and the impact to all of us in terms of how we think it frames crypto, digital assets, and all of us who are working within the space, even if you're not directly affected, we feel the knock-on effect. But what would you, in a sentence or two, what would be your main objective for the industry to focus on as a whole moving forward? What should be our aim as an industry? I would say mine would be risk management. That would be key. What would you like to focus on? I'll let you kick us off.
When you assume significant responsibility as SBF did, and then you burn this responsibility, every one of us, we now have to clean this mess, right? And I think the only answer to that is transparency. And blockchain actually allows for that. We have to make use of this technology and go back to the fundamentals. But that's the direction of travel. That's the only way we can rebuild ourselves as an industry.
I think that's going to be a great answer, right? Transparency. I would just add capital preservation. Not the time to be a hero. Like, we've taken our exposure down quite a bit in the liquid strategies, and it's not just crypto. There are other macro forces that need to be resolved before others are going to look at this space more aggressively. So passage of time and securing your funds to last for that duration.
Yeah, I think, to your point, the macro risks, the traditional markets are going through corrections. It's also finding pain points, no different to crypto. But it is a significant moment. I actually think, if anything, more institutional, more trusted players are going to come into it. Is it going to slow down the pace of the innovation or the appreciation? Yes, it will. There's no question, because obviously leverage is going to come down, and over-collateralization is not going to come through. Unsecured lending is going to slow down. That's actually going to reduce leverage. So there are issues we'll have to face, and I think the only way to solve that is when you have good trusted parties coming into the picture and being pretty transparent, and better tools as well.
I think it's humility, right? Like, we make no mistake, we are going through our Lehman moment for our industry, right?
Absolutely.
And for some of, I think all of us, by the look of it, we lived through that, right? I'm a lot more calmer now than I was in September 14th, 2008, when I thought the bottom was falling out of the world. And I know a lot of younger people, this is your first time going through something this crazy. So take a moment, all of us, whether we've been through this or not, and just recognize this is a colossal balls up. Like, this is a colossal moment, like, that we can learn from, but let's be humble. And like, a lot of this, and to have good risk management, you need to know what you don't know.
Yep.
You need to know that experience matters. And yes, you never want to take away the wonderful element of crypto, which is youthful enthusiasm, and you want to keep that, but you also want to recognize, like, sometimes us older dudes, I'll go ahead and put myself in that category, like, we've been around a time or two, so let's pay attention, let's be humble, let's be respectful, and in a couple of years, this will all be forgotten, and we'll be in another bull market, and it will be legitimate to have the Ferrari outside the door. But like, let's not do that. Let's be humble and just build ourselves back out of it,
Yeah. So I think it's about kind of bringing it back to basics, focusing on blockchain, focusing on humility and risk management within the system, and just continuing to build. And I think that's what we will all, in our own different ways, be focusing on doing. And I believe we wanted to have some time for questions. So are there any questions from the audience that you would like to put to the panel?
Thank you. Hi, a question for Galaxy. How are you guys looking to evolve in the crypto space, and what plans do you have to expand in the new products and services? What are your new narratives becoming the crypto world in the future? For Tim. Galaxy.
I didn't quite catch that, to be honest.
So basically, how are you looking to evolve in the crypto space? What are your plans to expand and add new products and services? And what new narratives do you see becoming big in the crypto future?
Well, actually, we had our Q3 results yesterday. So Mike Novogratz talked a little bit about our plans. We're going to put a lot of emphasis on asset management for sure. We're going to continue to apply our balance sheet on the sales and trading side with institutional players. you can imagine that we've got a pretty strong derivatives platform, and I think we recognize the importance of derivatives as a growth, as a piece of the puzzle to grow institutional adoption, which is the ultimate goal. So I think you can see us focusing on that. And our investment banking franchise at this point is kind of well placed to be advising people to do what we need to do. So I think we stay the course on the overall plan. There's actually no change. I think the theme that we've talked a lot about the themes, but let's just call and this goes back to the title of the panel. This is all about institutional adoption. So the theme is going to be, how do we get that trust to pull in those big pools of capital? I actually totally with Matt on the big sovereign wealth funds, the ADIAs, the Saudis, the Singapores, like they're the ones that have a lot of sway, and if we can get their trust, that's a signal for every other big pool of institutional capital to come in, and that's kind of the game that we're in. And I think the last part I'll say is the humility part. Like I think so on Monday in front of the Treasury Select Committee, we need to be a part of the voice that sounds grown up, but it has to have a little bit of a mea culpa. We have to sort of let them know, like, we get it. This was not good. Trust was broken, but here's how we're going to fix it. I think that's the themes I would focus on.
So yeah, on the VanEck side, we're kind of set with our liquid strategies. So we find the token opportunity more interesting now than the venture opportunity, because obviously the valuations have been marked to market. But we will continue, being active in VC with our early stage partner Cadenza, and then on the narrative side, yeah, I think it's a sovereign wealth, new BRICS. That will be the story that will turbocharge Bitcoin. So we want to be ready to capitalize on that.
Yeah, on our side, same. It's actually, we're coming into the market at a time, of course, market's going through correction. If anything, we see this as a significant opportunity on areas where we want to focus, trading, asset management. We see a lot of our, even investments will be focused on institutionalization, and the valuations will get more normal, and I think significant opportunity. And in a way, we are leading this space. Very few financial institution-backed entities are there. And fairly well capitalized, so we have the ability to grow fairly rapidly based on the opportunity set.
Mm-hmm. On our side, the fundamental avenue for our development is building the multi-manager platform, continue to expand that. What we're seeing is a migration of traders from TradFi into crypto, and our typical manager would be someone who traded for a large equity house on traditional space in hedge fund industry, and then did crypto on the side over the weekends, and overnight realized that's where alpha is, and ultimately moving to crypto. And that's where we are coming, offering up to 25 mil per manager, and allowing them to implement their view, their strategy on our platform. It has to be market neutral. It has to play alpha only, no beta exposure. And in the good years, people would come to us like, why do you bother, right? Kind of trying to extract 20% from the market when market does 400%. Well, in the year like that, when market collapses minus 70, you're not losing capital. That's a different game plan, right? And you immediately see the value. So we are connecting, in our particular case, institutional world to the ability to get exposure to crypto without fully directionality bet, but rather focusing on alpha.
Any more questions?
Hello. Hi, this is Jaff here from Composable Finance. My question is related to bridging TradFi to DeFi. So a lot of the interoperable solutions out there, the cross-chain bridges, they rely on trusted architecture. I mean, there's been over 2 billion in hacks in the past 2 years. So what is the infrastructure you guys are looking at to kind of integrate, to onboard institutions, banks, to provide DeFi services to the masses?
So what infrastructure are you focusing on in terms of onboarding institutions?
Well, I'll pick up on Anatoly's point about DeFi. Yeah, this is what the aggregate of what we're saying is if we can get the sovereign wealth funds to put large pools of capital into DeFi, we're getting somewhere, right? Like that would demonstrate the utility of this tool set that we have, and it is, we all believe in it, that's why we're all here. The challenge is AML KYC, and we're working hard to figure out how to create that wrapper, how to create that trust in a way that institutions and regulators like FinCEN in the US would be satisfied. And we've tested some stuff out, we've shown FinCEN some stuff, like if we can get into next year and get meaningful capital to want to go and participate in this, that would be a victory. And it's that little bridge tool set that is on the one hand super valuable, but also really kind of risky stuff. You know, you got to get it right, but like that's what we're focused. That's one of the things we're focused on.
Yeah, we're not directly active in DeFi right now. The risk reward is just doesn't look particularly attractive. Like we could engage with a Chainalysis, and you know that would give us the kind of stamp of approval to go ahead and do this. But there's it's just not attractive from a risk reward, and so just wait and see.
Yeah, on our side, we are definitely looking at it, and actually, to all the points, I think DeFi is essential. Particularly if you really believe traditional assets. I think the real issue with DeFi as well is, you know, the issue about recapture needs to be properly solved. For that, you need high-grade collaterals need to come into the system. I think that may happen at a time where more and more real-world assets get tokenized. That will be the bridge to create liquidity within DeFi. Then you have real assets as opposed to over-collateralized tokens, where ultimately the trust also is not there from recent events as well, what it tells you. But the big issue for the DeFi is for institutions, the integration needs to be easy. And then once you integrate into these pools, the next is, of course, the KYC AML aspect of it. Because you're pooling regulated, unregulated assets all together, commingling. And so today there are some solutions exist, of course, you know, segregated permission, more sort of pools. But for it to evolve a lot further, you need to have good solution around KYC AML, where seamlessly you can integrate and institutions can work without taking significant kind of unbounded market risk.
Mm-hmm. I think kind of the biggest challenge for institutional investors engaging in DeFi is not a tech, because they can jump over that hurdle and accept the way tech works. It remains KYC. They just cannot afford interacting with entities who kind of uncleared or unknown on the other side. And whether we like it or not, whatever is the ethos of crypto, kind of complete permissionless access, realistically, it will not work with these institutions. So we should end up running interactions on permissionless blockchain, but allow on-chain KYC so that select institution can interact with certain parties which have completed this KYC. And that would allow actually completely different level of engagement.
You'll still have the issue of the second and third degree of separation, right? And what risk is the fund manager willing to take that somewhere along the chain of command there's a very small % chance that there was a dirty wallet involved, and there is no guidance on what those correct risk levels are. So I think it comes down to like what's the rate of return available and like how much risk is.
How far down the chain can you go? Which is exactly the sort of to the gentleman's question. That's what we're trying to solve for. Like, is it 5 steps? Is it 10 steps? At what point are you satisfied that your duty of care, your fiduciary element is taken care of? I totally agree. Like that's unsolved.
Yeah.
There are always going to be some tail risk here, but that's perfectly fine. They say tail risk exists in a traditional banking system.
Right.
Otherwise, you wouldn't have these money laundering scandals, right?
Yeah.
So
that's why I find the whole thing kind of meaningless, right? Is that like, what is that? How do you define the tail risk? What %, right? No one really says it out loud. So we're either going to be in DeFi because it's worth the risk, or we're not. I don't think that like having a forensic chain analysis telling you stuff that you already know is actually that value add.
Yeah, I think we're at time now, but it's very clear that we've come a long way, but we've got a lot further to go. I'd like to thank all of my panelists here today for the great discussion and to all of you for joining us.
Thank you.